Intuitive Machine stock has been soaring in the previous 12 months. But what about the next 12 months? Should investors buy Intuitive Machine stock for 2025? That's the question I'm going to answer in this video, looking at the company's prospects, looking at its financial metrics, comparing it against the valuation to determine if I think this stock is a buy for 2025. So let's take a look.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
As you can see here, Intuitive Machines revenue has been soaring of late, 203 million in trailing 12-month revenue. That's up from around 80 million around January of 2024. Of course, this increase in revenue, the increase in contracts, the deals with NASA are partly what's fueling the fire in Intuitive Machines stock. The company has been soaring, to say the least. Now, looking at the profit margins, they've also been improving. Operating margin, even though it's negative at 21.57%, has been improving from the lows around January of 2024. More importantly, they reversed these trends of worsening operating losses and are making progress towards profitability, even though they're still in the very early stages of development of the business. In the most recent quarterly earnings call, the management team said that gross profit turned positive, 4.1 million for the quarter versus negative 14 million for the same quarter. The operating loss, even though it was negative, improved by 10 million versus the same quarter the prior year. And the company's balance sheet is absolutely pristine. They've got over $107 million in cash now, probably closer to $207 million since they made an equity sale in December. And so they've got zero debt and over $200 million in cash. And their burn rate in the most recent quarter was 19 million. So they've got a couple of years of cash runway before they need to go back to investors and ask for more money. That's plenty of time for the company that's innovating as quickly as Intuitive Machines. And they've got planned launches coming in 2025. If those are successful, undoubtedly that will lead to positive developments for the company, including potentially new orders, potentially increasing the stock price, which will allow it to sell shares at a more attractive price. And it'll also open the door for maybe raising some capital through borrowing at lower interest rates after they've demonstrated great progress. The cash flow from operations to sales is not progressing as well as the operating margins. Negative 38% in cash flow from operations to sales, not as much progress as the operating margins. They do have backlogs of orders of over $300 million. And so I don't think they will have difficulty raising cash because of those backlogs, because demand for its services exceeds supply. And they've done a good job of adding commercial payloads to their moon missions. And so that adds revenue at a lower incremental cost, which is attractive to investors longer term. Looking ahead, the analysts on Wall Street that are following Intuitive Machines, they expect the company will deliver a $2.34 loss in earnings per share in 2024, which will reduce to 15 cents per share in 2025 and turn positive. That's right, this company is expected to be profitable on the bottom line as early as 2026 with an earnings per share of 22 cents and continue the positive profitability on the bottom line with earnings per share expected of 23 cents in 2027. Now that we looked at the company's prospects going back and looking ahead, let's compare it against its valuation. And let me share with you why I use the forward price to sales ratio. The price to sales ratio measures what you are getting for the price you are paying in terms of sales. So what are you getting for every dollar in sales that you're paying? For example, in this first example, the market capitalization is $1.25 billion and the sales for the previous 12 months were $185 million. That means you're paying a price to sales of 6.76. Similarly, if you look at the expected next year revenue, you would be paying $1.25 billion for $465 million in revenue expected, and that would mean the forward price to sales ratio is 2.69. The factors that influence the price to sales ratio include profitability. Of course, you would be willing to pay a higher price for a company that generates higher profits. That means $100 in sales will turn into $20 in net income for a company that has a 20% net profit margin. That same $100 in sales will only turn into $5 in net income for a company that has a 5% net profit margin. So companies with higher net profit margins tend to sell for higher price to sales ratios, all else being equal. Another thing that influences the price to sales ratio are growth rate expectations. All else being equal, companies that are expected to grow at a faster rate sell for higher price to sales ratios. Similarly, higher total addressable market opportunities tend to result in higher price to sales ratio because investors see this company being able to grow for a longer period of time before hitting the ceiling. And finally, cyclicality. Companies that are more stable and less cyclical tend to sell for a higher price to sales ratio because cyclical companies are seen as being more risky. Companies like McDonald's are seen as being non-cyclical. McDonald's does relatively well whether the economy is booming or whether the economy is in recession. And so investors would be willing to pay higher price to sales ratios for companies that are less cyclical. Investors use the price to sales ratio when a company has negative earnings, unstable earnings that fluctuate between positive and negative, and also the same for cash flow. If a company has negative cash flow or cash flow that's fluctuating from positive to negative, the price to free cash flow and price to earnings ratio are less informative, so analysts use the price to sales ratio. So now that you understand the forward price to sales ratio, you can see Intuitive Machines here trading at a forward price to sales of 3.5 is near the most expensive this stock has been, save for a brief moment in 2022. So all things considered, do I think this stock is a buy, hold, or a sell for 2025? I rate this company as a hold / market perform. Perhaps if they make more progress, I wouldn't be surprised if over the next 12 months, perhaps I upgrade this stock, but for now, I'm keeping it as a hold. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.